Welcome to the show. Thanks for joining us. Today we're talking about evidence-based investing. Joining me in the studio is Carolyn Gowen, who works for Bloomsbury Wealth. Carolyn, welcome to the studio. What do you do?
What do? We do comprehensive financial planning and wealth management. We put the financial plan at the heart of everything that we do. So we will provide a financial planning service for clients where we don't manage any money, but we won't manage money unless we have a financial plan in place.
Okay, that makes sense. So we're talking about evidence-based investing. What does that really mean?
Okay, so evidence-based investors believe fundamentally that on the whole markets are efficient. That means all information that could affect prices is in the market, it's known, and therefore prices are the best reflection of share values at any point in time. If you believe that that's the case, then trying to beat the market becomes a bit of a waste of time, and therefore evidence-based investors tend to invest more passively, investing in index funds. Active managers believe that markets are inefficient and that there are price anomalies, and they try and seek the companies or sectors or geographical locations where they believe assets are mispriced and they can make money and beat the market.
So a good example of that might be something like Warren Buffett, perhaps, a name well known, who tries to buy companies where he believes that the intrinsic value of the company is not in the share price. It's undervalued relative to the share price.
Yeah. So Warren Buffett is probably the foremost value investor. So yes, as you say, he has a history of buying undervalued stocks and then and making a lot of money as they create their true value. It's interesting that his investment landscape goes back such a long time. There's no doubt he's an extremely intelligent man and skillful investor, but he did benefit from investing at a time when investing in value stocks was certainly a good thing to do, the 50s, 60s, 70s, 80s. It's interesting if you look at the past performance of his company, Berkshire Hathaway, over the last 10 years or so, it's tended to lag the S&P 500 US index because value stocks have been out of favour for quite some time, and it's been the likes of Apple and Microsoft and Google that have tended to be the big winners.
So why is it then that things have changed? Is it because of the sort of freer flow of information that it's harder to find a company that's undervalued? Is it because there's more known about companies?
The academic evidence shows that that's pretty much always been the case, and that there is a value premium. Small companies tend to outperform large companies. Value stocks tend to outperform growth stocks, but it's cyclical. So there will be periods of time when growth stocks will outperform and large stocks will outperform small stocks. But if you tilt towards value and small, you will get an enhanced return beyond what you'd get from just holding the broad index of stocks.
Okay, so let's talk about emotion in investing, and because it seems to me that this idea of evidence-based is at one level removing emotion, or have I got that wrong?
Well, you'd think, but no. If you invest in an index fund, you believe that you're just trying to get the market return. That doesn't make you immune from market falls or market rises, and emotions certainly can take over for people mostly when markets fall. So fear and greed are the main drivers, emotional drivers that investors suffer from, and that's everybody, whether you're an individual investor, whether you're somebody like me who's advising clients on investing, or you're a fund manager. It affects us all the same. And
there's definitely something about the sort of herd mentality, isn't there, as well? People like to do what other people are doing.
As an individual, it's extremely difficult to do the opposite of what everybody else is doing, and yet that is what you should be doing. Sitting tight when people are selling and actually adding to the assets that have gone down in value, and taking gains as they arise rather than people just piling more money in. That is the opposite of what, buy low, sell high. That's what you should be doing, and most people do the opposite. It's very, very hard to go against the herd. Again, it's ingrained within us to go with the crowd, for protection reasons and back when we were on the prairies hunting, hunter-gatherers. It goes back as far as that, but our brains are hardwired to do it.
So in terms of your experience, obviously you've seen both of those in relatively recent years, last 10, 15 years, those kind of booms and the busts, if you like,
Yeah.
the peaks and the troughs. What's been your experience of investing during that period?
Interestingly, the financial crisis, 2008-9, was unlike anything I'd ever seen before. I joined the industry in June 1987, so just before the October crash that year. And that was a remarkable experience to go through. But the market recovered very quickly and actually finished the year higher than it started. The financial crisis in 2008-9 was unlike anything I've ever experienced. It was relentless, and our process is that we have model portfolios, and if they go out of kilter, then we rebalance them back. So if somebody starts off with 50% in equities, 50% in bonds, and market movements mean that they end up with 60% in equities and 40% in bonds, we'll sell some equities, buy some more bonds, bring it back to 50-50. So when markets are going down, the equity element is falling in value, the bonds are staying stable or going up a bit, flight to safety. And so in September 2008, I rebalanced. That was okay, but then markets kept going down, and they kept going down, they kept going down. Between 2008 and 2009, I rebalanced once a month. And I was sick to my stomach every time I did it, because it wasn't my money, but I know the clients behind the money. I know what it means to them. I know how their financial futures rely on that money. And I was so pleased that we had a rules-based process, because it forced me to remove the emotion from it. I was crossing my fingers and hoping that our philosophy was right. And it turned out that it did work. But I think without that rules-based philosophy, I think we could have done what a lot of other wealth managers did, and try and beat the market, sell stuff, buy stuff, just sort of go into panic mode. But we didn't. We just followed, just stuck to our knitting and just followed our process and just rebalanced religiously. And then in 2009, March, when it really bounced back and ticked up, then I was selling the equities and buying more bonds. So our clients stayed fully invested throughout, according to their model asset allocation. So they didn't crystallise any losses, and they got the upturn when it happened.
So the clients must differ there in terms of each individual approach to risk. They're not all in the same things at the same time. No,
that's right. The most popular portfolio is 60-40, 60% equities and 40% bonds, and that, in a distribution curve, that's where the vast majority of us probably sit.
For the purposes of people who don't know what a bond is, how does a bond work?
Okay, so a bond is either issued by a government or a company, and it promises to pay you a set amount of interest during its life. It has a fixed life, and it promises to pay you a certain amount of interest and then return your capital.
So it's a bit like a loan, essentially.
A bit like a loan, yeah.
Okay.
So you're loaning money to the government or a corporation.
And they tend to be more stable than share prices of companies.
Yes.
Investing in companies, because of course companies' values and their products and services have good years and bad years.
Ups and downs, yeah. And government bonds tend to be less volatile than corporate bonds, because if you've got a company that is doing badly, losing money, the risk is that they won't be able to pay the interest or repay the loan at the end of the day. So company bonds tend to be more volatile than government bonds. And obviously smaller government bonds tend to be more risky than large government bonds, UK, US, etc. Most of the Western Europe would come under the very low risk. Yeah. Chances of a government defaulting on a loan is negligible.
Okay. So just thinking about that model then, and the decisions you make on behalf of your clients, does that apply to your own investing? Is that something you followed?
Absolutely, yeah. Not always, I have to say, but I've learned from experience. Yeah, my money is invested in one of our models, and I guess the only way in which I possibly differ from most of our clients is under MiFID II we now get quarterly valuations. I don't open them. I look at the 31st of December valuation only. I rebalance once a year, and that's it. The rest of the time I don't look at it.
Do you think then that there's a temptation with technology perhaps to look more frequently than is necessary.
Yes, absolutely. It's great having access to the information, but yes, I mean, not many of our clients, I think we have one or two clients who look at their portfolios every day, which is absolutely the wrong thing to do because all you're seeing is noise. But not very many of them do. But yes, I think the fact that it is also immediate and available, it doesn't help in terms of controlling emotions when you're an investor.
So some of your mistakes when you've been investing for yourself? Yeah,
I think one huge one which I'll never forget. Some years ago, I was working for a stockbroking firm in Devon, and we had a stockbroker in London who used to give us some tips occasionally, and he rang up one day and said, there's this South African gold mining company, you really want to get into it. He was a huge gold bug. He thought gold was the best asset. And he said, nobody's aware of it. They've got these massive gold reserves, blah, blah, blah. So I had to get compliance approval to invest in it. And while I was waiting for compliance to approve it, my heart was pumping. And that fear of missing out, that fear that this stock, this little tiny gold mining company was suddenly going to become public knowledge and everybody was going to be piling money in and I'd miss out. I invested not very much in it. The CEO was gunned down in Johannesburg a few weeks later and I lost all my money. That kind of shows you what kind of company it was. Probably never should have invested in the first place. But that was a hard lesson learned. And I think all investors have to learn. We all make mistakes and that is how you learn, by making mistakes. So it's okay to do it.
So in that spirit then of helping our audience think about investing and mistakes, what are your top tips? What are the things people should be thinking about?
Firstly, be aware that you are subject to these biases. We all are. There is no escaping it. And I think very, very few people can remove emotion out of investing altogether. The best thing I think you can do is keep an investing journal. So every time you make a decision to buy or sell something, you write down why. It won't stop you making mistakes, but it tells your future self what informed your decisions at the time, because another bias that we're all subject to is hindsight bias. We can look at the outcome of a decision and say, oh yeah, well, I knew that was going to happen because X, Y, Z. But if you can go look back and say, well, actually, Carolyn, 6 months ago you said you thought this was going to happen and that's why you were buying it, and that isn't what happened. At least you know why you did what you did. Mm-hmm. If you're making investment decisions irrationally, it's going to soon show up. You might make decisions perfectly rationally and then have the odd aberration, but a journal will hold you to account at a future date, and you'll be able to see, and you will learn from it, looking back and saying, why on earth did I think that at the time? Absolute rubbish. But it will help you obviously going forwards. More wealth is destroyed by emotional behaviour than whether you invest in an active fund versus a passive fund, whether you invest in an expensive fund versus a cheap fund. Emotions destroy wealth, biggest destroyer of wealth by far. So yes, there is. I mean, if you just Google behavioural investing, you'll come up with reams and reams of stuff about it that will help. Yeah,
that's fascinating. I might just do that. Thank you very much for your time,
thank
you for coming on the show.
No problem.
Thank you very much for watching. That's all we have time for, and we'll see you next time. Goodbye.